Interest rate is declining, and you know what that means? A bull run for the stocks. When the market turns green, there are a few stocks that are among the top gainers. If you can spot those stocks and invest in time, you can benefit from the bull run. So in this video, we have shortlisted 5 best stocks out of 75 different stocks. Most of these stocks not only increase your capital with the price gain, but also provide you with a passive income stream through dividends. When we say the best stock, what do we actually mean by that? Here, I tell you, the core purpose of investing is to make money, right? So the best stock should be one that pays well. That's right. Except there are a few more things to consider. The ideal stock should have a strong financial position. For example, it should have diverse revenue streams. If it is paying dividends, it should have a good history of paying dividends and must be a low-risk profile stock. This ideal stock must have a history of price recovery after fluctuations due to market downtrends and must be strong on the technical indicators. We closely looked at the market trends, government policies, and the performance of over 75 stocks to pick the 5 best stocks that you can invest in 2024. We need a stock that promises growth and stability, so there's no better option than investing in Johnson & Johnson. Let me show you why Johnson & Johnson could be your favorite stock to invest in 2024. First off, Johnson & Johnson is a leader in the healthcare sector. It has a history of showing impressive resilience. J&J has a profit-to-earning PE ratio of 13.79, which means it is an undervalued stock compared to the other options. For those who don't know, the PE ratio tells about the company's earnings per share and the price of a share. It's a good indicator to compare a company's valuation against its historical performance. The higher the PE ratio, the better the stock is. The companies with no earnings or are losing money don't have a PE ratio because there's nothing to put in the denominator. Now, coming back to J&J, it has a diversified portfolio in pharmaceuticals, medical devices, and consumer health products. This diversified portfolio makes it stronger against the market conditions. The trust factor is huge. With 80 hedge funds backing it, the investors of J&J aren't just average investors. Even the big players see its potential. J&J shares have returned 160% over the past decade, lower than the S&P 500's 212%. The same thing is visible in the 5-year return. J&J returned 17% compared to S&P 500's 88%. But let's not forget about dividends. Johnson & Johnson has a forward dividend yield of 3.38%. This might not be too much for risky investors, but for those who are more risk-averse, it makes an attractive option for those looking for passive income as well as capital gain. Seems impressive, right? But don't settle for that because we still have 4 more to go. Next on our list is Spotify Technology, a company that has revolutionized the way we listen to music and podcasts. Spotify is not just a music streaming service, it's a whole audio streaming industry with a strong growth trajectory. First, let's talk numbers. As of the first quarter of 2024, Spotify reported 615 million monthly active users. That's a 19% year-over-year increase. Out of these, 239 million are premium subscribers. This shows a 14% increase from the previous year. Numbers are the most convincing factors and show that Spotify has strong indicators that show it is expanding its market presence. Spotify's total revenue for Q1 2024 was 3.6 billion euros, which is up 20% year over year. Spotify has amazing operational efficiency, and all these numbers show positive growth of the stock and hence the investor's profit. Now, you might think that Spotify just has a single revenue stream, and it is quite risky to put all eggs in one basket. But that's not right. Spotify has diversified revenue streams. The company generates income not only from premium subscriptions, but also from ad-supported services. In fact, ad-supported revenue has been growing steadily, and it contributes significantly to the overall revenue. Spotify operates in more than 184 markets, and this market presence is the reason why it's showing massive gains in numbers. In terms of stock performance, it is very impressive. The stock price increase around 70% in 2024 compared to S&P 500's 14.84%. In the last 5 years, it grew 121%, outperforming S&P 500's 88%. This all might seem really convincing, like a perfect stock to jump in, but there are some downsides to it as well. Spotify, as of now, is not paying any dividends to its investors. Instead, they are reinvesting to acquire podcast companies and increasing its market presence. Also, Spotify has shown negative earnings, so there's no earning per share, which means no PE ratio. If you are someone who prefers capital gain and focuses more on the stock price, Spotify might be the stock for you. Next up is Google, or more accurately, its parent company, Alphabet Inc. Alphabet is a tech giant, and it is known for diversified revenue streams and consistent growth. As of Q1 2024, Alphabet reported $69.8 billion in revenue, a 12% increase year over year. The main contributing business to this growth was Google Services, which includes Search, YouTube, and Google Cloud. Google Search remains the dominant player in the search engine market and holds over 92% market share, which is insane, right? Now, Alphabet's net income for the same period was $18.5 billion, which is a strong profit margin. Now, coming to the revenue streams. Advertising remains the primary source, which makes around 80% of total revenue. Google is also expanding its Google Cloud services, which generated $7.5 billion in revenue in Q1 2024. This is a 28% year-over-year growth. The more diversified revenue streams a company has, the more strongly it can stand the market fluctuations. We all know that this is the era of AI, ChatGPT and stuff. So Google is heavily involved in artificial intelligence. It has launched its AI model Gemini and dedicated a sector for R&D. So we can expect major things happening and probably more growth and more revenue streams adding. In terms of stock performance, Alphabet is a consistent performer. So last but not least is Altria Group, a company that might be a bit controversial, but has been a consistent performer in terms of dividends and price appreciation. Altria Group is one of the world's largest producers and marketers of tobacco, cigarettes, and related products. Though there is a declining trend in smoking, Altria has managed to maintain a strong financial position, and it is paying huge dividends to the shareholders. As of Q1 2024, Altria reported $5.3 billion in revenue. The company's net income for the year-over-year was $2.1 billion. That's a solid profit margin. Altria has an impressive margin standing at 39.06%, which is unprecedented compared to similar companies. And this number alone shows high operational efficiency and cost management. So it's a tobacco company, and there must be a strong reason why investors love to invest in it. Actually, there are many reasons for this. Altria is committed to returning the value to the shareholders and has a forward dividend yield of 8.2%, which is one of the highest in the industry of the same scale company. Investors can earn huge passive income and also benefit from the stock price increase, which we will discuss later. For the past 50 years, Altria has been paying consistently increasing dividends, which is a major plus for income-focused investors. Altria's PE ratio stands at 10.5. This means that the company has been showing positive earnings, the stock price is still undervalued, and there's room for growth. The stock price increased by 15% in 2024, and in the last 5 years, the stock price increased by 45% while also providing consistent returns to the investors. These are some of the most promising stocks that you can buy in July 2024. Some of the stocks are good at price appreciation, like Spotify. Stock price is making huge bullish moves. Stocks like Altria pay huge dividends, but have a higher risk profile. Stocks like Alphabet and P&G are all-rounder, and you can expect stability and growth. If you are considering to invest in one of these stocks, here's the pro tip. The Fed is expected to cut interest rates, and you should invest in these stocks before that. Here's why. When the Fed cuts interest rates, the borrowing costs decrease. This ultimately increases spending and business investments. This typically leads to higher stock prices. Therefore, if you manage to invest before the interest rates are cut, you might be able to benefit from the stock price increase. This concludes our today's video. Thank you for watching. Subscribe to our channel if you haven't already.